Hello everyone, welcome back to my channel. I'm your host Miss KK and this is The Wave. It is your weekly show that looks at topics related to personal, family and business finance, and our hope is that by the time we get to the end of this conversation, you are really better equipped to make sound financial decisions. So if you are new here, thank you very much, and if you're already a returning subscriber, an awesome appreciation. So on my Instagram last week I posted a question of which video I must film next. It was between vehicle financing, black tax during festive season, as well as construction, and vehicle financing came at the top, and we are diving into vehicle financing today. So I just want to share two experiences that I had with vehicle financing this year so that I can just illustrate why there's a need for us to really understand vehicle financing before committing to these deals. So I had a friend that reached out to me. She was in the market for a car and she had gone to the car dealer to ask the price for a particular car, and the car dealer obviously informed her that she needs to put up a 10% deposit. So she came to me and said, if she put up the 10% deposit, can I please help her calculate how much you'll be able to pay on a monthly basis in terms of a car loan repayment, and we should do a rough estimation of what the installment would be, what the insurance would be, what the fuel consumption would be, so that we can determine an overall how much will this car take away from her budget. So when we did that assessment, she concluded it's slightly tighter and she would go back to the car dealer to determine what other options she has. And the car dealer offered her the option of a zero deposit, and she was wondering, why is it that if she takes the zero deposit, the cash price that she's being quoted is higher than the original price she was quoted. So let's just say, for argument's sake, the original car she wanted to buy was 300. 10% of that would have been 30,000, and that means the cash price that she was going to be financed on which the loan repayment would have been calculated would be about 270,000. And then she went back and she said, what if I don't take a deposit? Then the car dealer or salesman calculated that the cash price for her would be 313. So she was quite confused how the 313 is higher after that number being only 90% of the value of the car, and the original price was about 300. So what I actually realized is the car dealer took the 30,000, which is the 10% deposit she would have paid. Then they said they would future forward that in 5 years at the interest rate that she's going to be charged at the bank. So let's just say, for argument's sake, she's being charged prime, and at the time prime was about 9.5. So they took 30,000, future forwarded it into 5 years at prime. So if they had to go invest this money at the bank, they would have been able to generate a return of 9.5 per year over the next 5 years. And then they calculated 90% of the original price plus this future forwarded, and then took what the amount would be, and that's how she ended up at 313. And she was quite upset. How is it that the price is higher? Then I told her, the car dealer is not in the business of giving vehicle financing. That is your business with the bank. So now they are assisting you. It's only fair for them that they are giving up the interest they could have earned on that money. That's why your price is higher. So I was able then to calculate for her similar situation, what the installment would be on that, what the total vehicle cost would be, and she then walked away with more insight in order for her to be able to make an informed decision. That was situation number one. So situation number two, I had a friend who had a car that was on balloon payment that came to an end. That car came to an end, but she wasn't aware that the bank actually charge interest on the residual value. So when you buy the car, the bank may tell you it's 30% residual value, 30% of 300,000 may be an X amount. But in 5 years' time, you won't pay 30% of the cash price. You will pay 30% of the cash price plus the interest that accrued over the 5 years, and you need to pay it upfront. So obviously, she got to the 5 years or 6 years she had been given the loan. She didn't have the lump sum in full, so she had to go draw on her saving to pay a portion of the lump sum, and she had to make a sort of like a repayment arrangement with the bank to deduct the amount over 3 months. 3 months is quite a short period of time to pay a high lump sum, and it was quite steep on her budget, and she struggled but eventually she managed. But it just illustrated the point that when we commit to these things, we really ought to read the terms and conditions so we are not caught by surprise at the end of the day. And that is the purpose of this video. Although a lot of people ask me from the perspective of I need to be able to highlight which bank offers the best interest rate in terms of vehicle financing, I don't think that is the main issue that you need to be concerning yourself with. At the end of the day, a car is a variable linked instrument that is normally financed at prime plus or prime minus depending on your risk profile. So prime is the benchmark at which all lending decisions are normally made, because prime is the basis that commercial banks use. And we know that we are currently in times where there is an upward trend in repo rate. Repo influences directly prime, and when prime increases, whatever we are charged on loans would also increase, because most of the home loans, car loans are variable linked instrument rate, meaning they change with the repo rate. So that's the one thing. So if you are going to compare a deal from bank A to bank B, what you should be really looking at is, what are the terms and conditions? What interest rate am I being charged? What repayment terms am I being charged? And is there any residual value? Is there any deposit requirements on these two? Then you compare the two quotes that you are given and decide for yourself which quote is cheaper. Obviously, your risk profile at a bank you currently banking with might be slightly different from a risk profile of a bank you might be going to, because if you are already banking with a particular banking institution, they already know your banking history, they know your payment patterns. If you have any loans with them, they would know how you handled those loans, and they might give you a discount for maybe having a home loan with them, a credit card with them, and now you are taking a car loan with them, meaning they might consider you a good customer and they give you a prime minus. Whereas another new bank that you might be going to might consider you high risk because you're not banking with them, although they may pull your credit report and see how your payment histories are, but they could also be keen to offer you a low interest rate so that they can pull you from the previous bank and hopefully acquire you as a customer. So there's a lot of consideration in determining what interest rate do you end up getting charged at the end of the day, but that is not something I can conclude for you. That is something you need to conclude for yourself after making comparison between those two banks. So the main aim of this video is not go into the different institutions, but rather to go into the terms and conditions and help you understand what really goes in vehicle financing. And we've already touched on the fact that you need to understand how repo is going to affect you and where repo currently is and where repo is likely to be. I also have a separate video on where I explain what is repo rate, what is prime rate, and how it affects you when you have a vehicle loan. So you can also watch that video. I can link that video up in the description below as well. The next thing we need to look at after discussing the repo rate is repayment terms. So the common repayment terms in Namibia are 60 months or 72 months. 60 months is the ideal term because that's almost like the minimum banks give to people that are looking for vehicle financing. Of course, you are not obliged to pay over 60 months. You can pay your car shorter than that if you have the money, but minimum is about 60 months that they normally would give you per the contract, and the extended term is 72 months. So 72 months is normally given to people that can't really afford the installment if it were to be on 60 months, or if you really request that you just want to have a bit of flexibility and you might want to take the 60 months. So what I want you to understand here, the shorter the term, the higher your installment is going to be per month, but overall the cheaper it would be for you because you are going to pay lower interest overall. The longer the term, the lower the installment, but the higher the interest. So the car will cost you a lot more. A similar car will cost you a lot more if you were to take it over 72 months as opposed to someone taking it over 60 months. So that is the main understanding that I want you to have. Then the other thing that you need to bear in mind is the purpose of the car. We've already discussed this in another video. Also, you need to look at the size of the car. What are you going to use this car for? You need to look at fuel consumption. This you can get from the car dealer. You can mainly ask them, what's the rate per kilometer of this car? How much fuel does it consume per kilometer? You can ask about the safety, regarding traction on the road, regarding, braking at a high speed. And also, just given that there's high rate of accident on the road, you want a car that is safe. But most of the time, the safety of the car depends on the driver. Most of the cars are generally safe, but we as drivers are the one that exhibit reckless, behaviors that could endanger our lives. But it's also something that you just need to check with your car dealer or with your friends that drive similar car, how safe that type of car is. And of course, the carbon emission, we can't ignore the impact that it has on the environment. More newer cars likely to be a bit more, safe for the environment, and the more older cars tend to emit more carbon emission that is unhealthy for the environment. So that is really some of the consideration that you need to look at. When you then decide you are going to go for a particular car, you can test drive the car. When you test drive the car, you generally go with a person from the car dealer. You can take a friend with so that you can just get a feel of the car. And when you're comfortable, you then need to decide if that car that you are likely to take, if it's consistent with your budget. And this is where we need to come back to the other costs associated with the car. Don't just look at the car and think the car installment that the bank is going to charge you is the only thing that you need to pay. You need to pay that car installment. You need to be aware that there's annual license disc that you need to pay that is renewable every year. There's maintenance of the car. A brand new car is likely to come with a maintenance plan, but also even with a maintenance plan, there are certain things that you need to replace that are outside the maintenance plan. For example, if your tires are worn out, those tires are not going to come off maintenance plan, so you need to be able to budget in order for you to accommodate that. Fuel is one of them, and parking fees is one of them, and life insurance is one of them. If you already don't have an existing cover that you're going to seed to act as credit life for this car. So overall, these are the other cost consideration. When you put this in your budget, are you going to be having a breathing room in your budget, or is this going to have you at a chokehold? So these are some of the things that you really need to be able to take into consideration when taking a car. And obviously you can ask your dealer to work out for you how much it is, or you can use a vehicle financing calculator at the various bank website in order for you to determine roughly how much the installment is going to be. Insurance, you just call up an insurance car dealer, you tell them the model of the car, the value of the car, they will calculate for you the insurance. But it's always best for you to shop around insurance, because insurance A and insurance B might have completely different premiums, and most of the time they are willing to beat your previous quote. So if you can get a cheaper quote and get it to this new insurers, they are likely to reduce your quote to try and attract you as a customer. Given the various cost consideration that you are now aware of, I'm going to take you how to do a sort of like a sensitivity analysis to determine which scenario is best for you. We are going to be using a vehicle financing calculator used by Bank Ventuk. There are various vehicle financing calculator. Every bank in fact has one. I just used Bank Ventuk because I've used it before and I saved it in my favorite. So the banking calculator would require you to put what the cash price is for that car, what the purchase price is for that car, and that you'll be able to get from the car dealer. You call up Indongo Moto, Indongo Auto, whatever the case may be, or maybe Bukkevet's Toyota, and they'll tell you for this car that you're trying to buy, the price is how much. Then you also need to know how much deposit you are willing to put up. Most of the time would require you a 10% deposit, but as I said, you can put up a lot more than that, or you can maybe not put up anything if the bank is running a zero deposit deal. You may also then have to put a balloon payment that is related to the terms and conditions that you are being given by that bank. Some banks will offer you balloon payments, sometimes you don't need a balloon payment. You then need to find out what interest rate that you are going to be charged. That you need to find out from your bank, and you need to find out what your repayment terms is, whether you're going to take it over 60 months or 72 months. Generally, you don't want to do this assessment over a shorter period of time, because banks normally don't approve a shorter period of time, but it doesn't stop you from paying over a shorter period of time. They can calculate an installment for you over 60 months, and you decide you don't want to go over 60 months, you just want 48 months. Therefore, you're going to pay an installment as if your car was on a 48 months period. So I'm going to do the ideal situation, which is 310% at 60 months. And then I'm going to do a sensitivity. What if we put up a higher deposit? What impact will it have on the monthly installment and the total price we would have paid? What impact would it have if we take a balloon payment, so that you can see how it makes a difference? Okay, we're starting with scenario 1, which is 300,000 as a purchase price, 10% deposit, which is 30,000. And interest rate of all these scenarios would be prime plus 1, which is prime is currently at 10, plus 1 is 11. And when we put that in, it will throw out that we need to be able to pay 5,870. And when we are done with this car, we would have paid back the bank 352,277. All right, then let's do scenario 2. Scenario 2, you decide that, hey, I actually have been contemplating about buying this car for the longest of time. I'm not going to put up 30,000 deposit. I'm going to put up 60,000 deposit because I have the money. And we are keeping all the other variables remaining the same. And we are saying your installment is going to be reduced to 5,218. So instead of you paying 5,870, you are now paying 5,218, which is about 652 cheaper than the original price. So by you putting an extra deposit, you are already saving 652 on a monthly basis on your installment. And we also said by the time you pay back this car, you would have paid back in total repayment of about 313. So basically, by you putting up an additional 30,000 deposit, the original 30 plus 30 to give you the 60, you saved yourself about 39,000 in terms of interest. So your total repayment on the original would be about 352,227, whereas if you put up a 60% deposit, you would have paid $313,090, meaning you save about $39,000 in interest. So it's not a myth that if you put up a higher deposit, it makes an impact. It just might not make a big impact on your monthly installment, but it definitely makes a big impact on the total repayment. So that is scenario 2. Then we're going to look at the last scenario where we're saying that you're taking this car, it's 300,000, 0% deposit, 3% balloon payment, 11%, and because you need a little bit of a push, you're going to take it over 72 months. So if we calculate what your monthly installment would be on that, it would be about 4,882. If we are going to compare this installment to a normal repayment in terms of 10% deposit and over 60 months, you are going to be paying $1,048 less than that person. So your monthly installment is cheaper by $1,048, but your total repayment term at the end of this car would then be the 347, which is your installment. And if we take the balloon payment of about 90,000 and future forwarded it in 5 years at the interest rate that you're going to be charged 11%, that balloon payment would have grown to 151,000. And if you add those together, you're going to pay back 498,000 over the term of the car loan. So essentially we are saying a balloon payment is a lot expensive, and if you can avoid it, because at the end of the day, not only do you need to be able to pay a lower premium, but during the term of the loan you need to be able to save so that you can save towards this 151,000. So if we then take the 151,000 over 72 months, that means you need to be able to save a 2,106 per month in order for you to have enough money at the end of the term. But what are the chances that you are going to be able to pay this 2,106 if you're already struggling to pay the 5,800 on a monthly basis? Unless you are maybe that person that get a bonus each year and you are going to put aside your bonus over the next 5 years in order to save towards this balloon payment, it is just essentially going to stab you in the back. So that is really just the one thing I wanted you to be able to familiarize yourself with. So we've then dealt with how to calculate your installments on using the vehicle calculator. In addition to the vehicle calculator throwing out how much your monthly installment should be and how much you pay back at the end of the term, it also throws out how much you need to be able to make in order for you to qualify for this car. So if you look at the option that has a balloon payment, you need at least 19,200 in order for you to be able to qualify for this car. But if you take the option that doesn't have a balloon payment, you would need about 23,000 in order for you to be able to buy a car on this balloon payment. So basically that is what I wanted us to discuss on balloon payment. So overall here, I just want to conclude to say that, look, a car is a cost, and the cost of the car is not just an installment. It is about installment plus all this other cost. A car loan is a variable linked instrument. You need to be able to assess your affordability today when the interest rate is at X%, and what happened when the interest rate shot by, I don't know, 2% or 3% from what you actually were qualifying for, and whether you are going to be able to afford that car. You then need to decide whether you're going to put up a deposit or you're not going to put up a deposit, bearing in mind that the deposit would save you interest and would also make your monthly installment lower. And if you are going to take a balloon payment, understand what the balloon payment terms and conditions are. Understand that it means that you're going to pay a lower premium on a monthly basis, but overall you are going to pay that car at a higher price, because not only are you charged interest on the reduced amount, but you are also going to be charged interest on this balloon payment that you would be required to pay upfront. So if you don't have the money at the end of the term, you are either forced to refinance that car, or you are forced to sell that car and hopefully use the proceeds to settle the car, the remaining portion of that car at the bank. But do remember that it's not always guaranteed that the car is going to be worth that much at the end of its useful life, especially if there's a high mileage on that car, and especially if you don't take care of that car. So that's the main principle that I wanted us to take out from this. And lastly, I just want to touch a little bit of vehicle financing that involves payment holidays. Most of the car dealership I've noticed are advertising in conjunction with the banks, advertising up to 3 months payment holidays. So you essentially get your car at the end of November, and you are able to drive it January, February, March, and you only start paying in April. So yes, that's a good thing, because it will give you breathing room for about 3 months without paying for the car you are driving. What I want you to understand is whether the payment holiday is suspending the installment, or it's suspending the installment and the interest from accruing. Because if it's not suspending the interest from accruing, it will be in your best interest to start paying regardless, because overall you are just adding more and more cost on your car. But if it's suspending both interest accrual and repayment, then you are actually not losing, because you would still be able to save that money or use that money for other things. And when you start repaying, you still be repaying the car over the original 70 months or the original 62 months that you were given. 72 versus 6 that you're given. So really, that's all I had from this vehicle financing video. It's nothing complicated. It is really just you understanding the interest rate, the terms, the balloon payments, and payment holidays. And it's you understanding that you need to shop around for this cost-studded insurance, life cover, maintenance plan if need be. And it's also you understand that you may need to shop around for interest rate, and also adjust your spending behavior over the term of the loan in order for you to make it bearable on your pocket. So other than that, thank you so much for tuning in. This is all we had from this week's video. If this is the type of content that you'd like to hear, please don't forget to subscribe, hit that like and notification bell so that you can be notified every time I upload a new video. And until next time, it is goodbye, and please stay safe.